In this video, we're going to take a look at a financial instrument that could be an excellent addition to your portfolio, especially if you're looking at a financially secure way of getting your money to work for you without taking on unnecessary risks. Money market funds are often targeted not just by everyday investors, but also by large organizations because they prioritize stability and liquidity while still offering a higher return than you might get from a typical savings account with a bank. So, firstly, we need to talk about what a money market fund is. And I think of it in similar terms to an ETF that invests in a lot of different companies to provide a return of an index or benchmark. Only in the case of a money market fund, rather than investing in companies, it purchases lots of highly reliable short term debt. This means that your money is invested in debt securities such as short dated bonds from trusted borrowers such as US or UK governments or corporate bonds issued by large, credit-worthy, stable companies. These borrowers then pay a competitive interest rate, which is often better than the rate you get in savings accounts in return for the loan. As the securities are short dated, it's generally only a matter of weeks before the money is returned to the lender or ETF in the case of money market funds. So there's constant turnover, meaning that money market funds have general good liquidity. There are obvious differences between money market funds and general cash savings, but one of the main ones from a risk perspective is that while savings accounts are insured under the FSCS compensation scheme, which provides up to £85,000 per individual in the event of a bank failing, money market funds are not. That being said, for UK and European investors, they're protected by the regulations and compensation schemes that apply to UCITS funds, or undertakings for the collective investment of transferable securities, if using the full name. This means that you can invest larger sums into a money market fund, knowing that assets are segregated from the ETF provider so that they cannot use them to settle debts should you run into financial difficulties. They must also be sufficiently diversified so that no single asset within the fund is worth more than 20% of the fund's value. No counterparty, if the fund uses a synthetic swap as means of replicating the index, is permitted to be exposed to more than 10% of the fund's value. And UCITS regulations also require an ETF to be liquid and open-ended, allowing investors to redeem their shares through their broker in cases, for instance, where trading on stock exchanges is restricted. Money market funds are extremely stable, and this means you typically won't see fluctuations in the value of your investment, which makes them appealing for anyone who wants both safety and easy access to their money for a higher interest rate than with cash savings. So how do money market funds work? Well, they pool investor money together, similar to how other ETFs or mutual funds would operate, and the fund managers then use that money to buy high-quality short-term securities like UK gilts, US treasuries, certificates of deposits, or commercial paper. These investments are chosen for their reliability and short-term timeframes, which help keep the fund stable. The returns then come from the interest earned on these securities and will be in line with the overnight interest rate that your ETF tracks. And while it might not make you rich, it can provide consistent, predictable growth over time. So why will you use a money market fund instead of keeping your money in a savings account? Well, as with most things to do with saving and investing, it really depends on your goals. Money market funds typically offer higher yields than savings accounts, which can make a noticeable difference if you're saving for a short-term goal like a vacation, a home ownership payment, or even an emergency. Plus, they're more flexible than a certificate of deposit, which is another name for a fixed-rate bank account, where you have to lock up your money for a set period. Many investors decide to park their spare cash in a money market ETF as a short-term safe haven asset in the expectation of earning extra interest before they redeploy their money into higher growth assets as the markets recover. When trying to decide between money market funds or bonds, investors often choose money market ETFs to take advantage of a rise in interest rate environment. In this scenario, longer dated bond ETFs will take capital losses as yields increase, whilst money market ETF capital values are almost immune to this effect because their assets are short dated and mature so speedily. Moreover, money market products rapidly reinvest the principal as their holders mature, so they quickly benefit from the higher rates of interest offered by newly issued debt securities. The bottom line is that money market ETFs are much less volatile than bond funds, and they're quicker to pass on benefit of rising interest rates, which banks are often slow to do with cash savings. To get a better understanding of what a money market fund looks like, I'm going to look at one which is very popular with UK investors, which is the Amundi Smart Overnight Return UCITS ETF, sterling hedged, accumulation with the ticker ID of CSH2. This is an active ETF, and the benchmark index it seeks to beat is the Eurozone equivalent of SONIA, which is the sterling overnight index average, the rate that banks lend to each other overnight. It adopts a synthetic replication structure to achieve this objective, so instead of directly holding the underlying assets, CSH2 uses unfunded swaps with stable financial counterparties like Societe Generale, BNP Paribas, and JP Morgan. Although active, the fund has a reasonably low total expense ratio, TER, or ongoing charge figure, OCF, at 0.1%. This is the fund manager's charge to administration, and any return figures that are published and mentioned here are net of this figure, having already been taken into account. The risk profile on a scale of 1 to 7, with 7 being the riskiest, is 1, which is very similar to but slightly higher than the risk of cash savings, and the fund sizes are reassuringly large and established at over 800 million sterling. Year to date, the ETF has returned 3.47%, but we are only three-quarters of the way through in September, and the final annual figure is likely to be nearer or above 5% if interest rates remain unchanged, and the one-year return is 5.02%. You'd find it difficult to match that rate with any easy access savings rates out there, and even locking your money away with a bank to get a fixed rate is unlikely to achieve this rate. And if looking back to 2024, CSH2 managed to beat its benchmark, achieving 5.5% annual return. This doesn't mean that it will beat this index or better cash savings interest rates going forward, and past performance figures should not be used as a reliable indicator of future returns. So where can I invest in a money market fund? Well, it is easier than you think, with major financial institutions and investment platforms offering them. Two low-cost ways of doing this would be by opening an account through either Trading212 or Invest Engine, who do not charge any platform fees. They both offer a choice of money market funds for you to invest in, including the one featured in this video. And you can also open stocks ISAs with both platforms, meaning that interest earned from your fund of choice would be protected from tax. With both, you can usually invest in a money market fund with a very small starting amount of money if you just want to dip your toes. And whilst on the subject of being cautious, I want to take a look at the low but still real risk associated with money market funds, as while they are very stable, they're not completely risk-free. For instance, during times of extreme market stress, there is a small chance of break the buck risk, where the fund's value falls below £1, meaning that the investor loses principal. Credit risk exists if the borrowers, such as governments or large corporations, default on their loans and fail to repay the lender. Liquidity risk could prevail in extreme cases, for example, market panic, where a fund may struggle to meet redemptions quickly, potentially suspending withdrawals. Some money market funds, like CSH2, use swaps rather than holding physical assets, and this introduces counterparty risk. Unlike UK savings accounts, money market funds aren't covered by the Financial Services Compensation Scheme. If your fund provider fails, you could lose money. Interest rate risk could cause your income to fall as rates reduce, much like cash savings, whereas inflation risk always applies, and money market funds rarely beat inflation. Over time, your purchasing power may be eroded even if the nominal value stays stable. But remember that they are protected by the regulations and compensation schemes that apply to UCITS funds, which will therefore mitigate counterparty liquidity and credit risk. Well, I hope that this video has provided you with enough information to help you continue to research and deciding whether money market funds are right for you and your individual circumstances. They're not for everyone. Some more risk-averse investors prefer to instead choose to stick with cash savings to eliminate some, but not all of the risk we mentioned for a lower interest rate. We'd also have to consider whether money market funds are right for you if investing for the longer term, where they are less likely to keep pace with your cost of living, and where your money's value will invariably be eroded the longer you invest. If you do have any questions or comments, then please leave them in the box below. And thanks very much once again for watching.